Andrew Gray heads PwC's consulting practice for the UK banking industry, joins me in the studio now. So when we speak about ring fencing, important to make the distinction here. And of course, John Vickers said, look, this isn't a total separation of retail and investment banking, but it is a hard, robust ring fencing, which means that effectively they become subsidiaries. I
think that's right. I mean, the key point is that banks are going to have to create separate subsidiaries, and retail banking activities as defined by ordinary consumers, a man in the street, plus small and medium-sized enterprises will need to be within the ring fence. There is some flexibility about corporate customers where banks may have them on either side depending on the nature of services they provide.
OK, so is that flexibility a good thing? Does it give them more room to manoeuvre?
Well, it's not so much room to manoeuvre. I mean, the critical thing is the ring fence is there. What it does do is allow banks to sort of treat their corporate customers in a way which would make sense for those customers.
What about criticism that actually ring fencing is a half measure? If you want to really create long-lasting stability, why not just separate the two sides of the business completely? Does this now lessen the potency of that argument?
Well, I think what the report does do is it clearly states that retail banking activities must be within a ring-fenced subsidiary. That's a separate legal entity which has its own capital requirements. They've also made recommendations on the way in which that entity will be governed, so it will require its own board, and in effect will require many of the same disciplines that a separate company would require, but it doesn't force a separation completely away from the rest of the banking group.
Now, he also said that ring fencing will help boost lending or liquidity in retail banking, so it'll help fuel actually more money, not less, into the domestic economy rather than going towards investment banking. Is that your reading of the situation?
I think that's slightly more complicated. I mean, what he'd also said is that the cost of banking is going to go up. Banks will require to raise more capital, and I think that the suggestion was that it's between 4 and 6 billion cost to the banks each year. That cost is going to have to be covered somehow. So whether that results in less lending or more lending, I think is yet to be seen.
Well, he did also say that the cost of improved financial stability isn't going to come for free. He didn't elaborate. He didn't get any more specific than that. But, you know, we are hearing that the impact of these recommendations will amount to £7 billion, for UK's banks. So who is going to bear the burden of this cost?
Well, I mean, again, that will vary from bank to bank, but banks will need to raise more money. They compete for that money in the international markets, and they have to pay an economic return for that money. In reality, I think a lot of the costs are going to have to be passed on to consumers. Otherwise, the banking sector will not be profitable and will not be able to maintain the level of capital it requires.
Quickly, your thoughts on the timetable. Capital requirements are stronger and more robust than those required by Basel III, and Vickers is saying pretty much the same timetable as Basel III agreement, the start of 2019.
2019 seems a realistic time frame. Banks already know that they were going to have to set aside additional capital for that deadline, and I think these incremental amounts are reasonable within the time that's been specified.
Thanks very much indeed for joining us this morning. Andrew Gray, Financial Services Consulting Leader at PwC PricewaterhouseCoopers.